Welcome back to It's Only Money with financial advisor Scott Brown with Edgewater Family Wealth and EdgewaterFamilyWealth.com. Good morning, Scott. Good morning, Tammy.
Morning.
Another beautiful Sunday. How are we doing, fellas?
Well, living the dream, brother.
Yeah.
I don't know whose dream, but I'm living a dream.
It's my dream, definitely. So I'm glad you guys can be on board with it as well. I always wanted to be part of Orlando's hottest financial show.
Well, then you're welcome.
Yeah, exactly. So, yeah, you got notes today, Scott. I like
did.
this.
I thought for once I would not talk from the seat of my pants, which is a lie because I will eventually be talking from the seat of my pants, but I figured it's an organized chaos, if you will.
That's the way to do it because I have like fever dreams where it's like, all right, Ryan, what are we going to talk about? And then I have nothing. I'm like, how do pennies work?
That's how penny sounds.
These are my fever dreams, and don't judge me for them. But let's talk housing, Scott.
Yeah, all the exciting topics. So last week we had a little tangent about housing and how people think their houses are their best investment, which is not wrong. It's really, the conversation centered around the fact that when you own stocks and they go down, people freak out and sell them, right? Because that's human nature. What happened yesterday is going to happen tomorrow. But with homes, they don't have that option. If your house drops in value, you still have to live there, right? So I think people are more interested in housing even as an investment, quote unquote, than they are stocks and bonds because I wouldn't say almost everybody, but a high percentage of Americans own homes. So the question that begs asking is, Tammy,
yeah. So
how is housing doing?
Houses doing?
Oh yeah. Well, houses they look very well actually. But if you want to look at the top 3 companies that build houses, and we look at their year-to-date performance, for example, we're looking at Horton. It is negative 27% year-to-date. Doesn't sound very promising there, but the Pulse Group is negative 23, and the NVR is negative 21.
So these are the 3 largest home builders in the country, I think. And what's interesting about that is if you think, well, if the end of last year when housing was just completely out of control, like exploding everywhere, what would you think you should buy?
A house.
A house, number one. But what else? But what else? What's another proxy for a good housing market? You would have bought these stocks, right?
Yeah, I would have bought stocks in these companies, but. Is it because they just didn't want to build houses? I mean,
no, they like building houses because that's how they get paid, so they're in favor of that. Mm-hmm. But the point I'm trying to make is if you look at things just on the surface and you say, well, housing did so well last year, I think I should buy some housing stocks. But the reality is they didn't perform very well year to date. So really that cycle, you'd be kind of late to the party for that, right? You'd say, well, I'm waiting for housing to do well, and once it does well, I'll buy those stocks. No. You should wait for housing to do poorly, get the stocks when they're depressed like they possibly are today. I'm not saying they are or they aren't. They're clearly depressed from where they were at the beginning of the year, right? They're a better price now. Now, does anybody want to buy those stocks today? If Tammy walked down the street saying, hey, man, you should buy Pulte or you should buy Horton, they're down 30%, people will laugh at him, right?
Yeah, they're sad. They're sad stocks. They're depressed.
They're depressed stocks. Yeah. They're very sad. But if he said these stocks are up 30%, everybody would want to buy them. So it's really we walk around saying, if I say to the average person, do you buy low and sell high? They'd say, yeah, you definitely do that. That's the rule. And then when it comes to actually doing that, nobody wants to do it because when things are down, we assume, based on recency bias, that they're going to stay down, and where things are up, we assume because of recency bias they're going to stay up.
Well, I definitely know the buy low, sell high. The problem is on my Robinhood app, I'll buy low, and then they just go low, 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 low.
You're catching a falling knife.
Yeah,
is what you're doing.
But I'm staying in, because I'm always, my mentality is, I got time. Let's just see what it goes. Can a stock hit absolute bottom and then the company fails?
Yeah, bankruptcy. You've heard of Enron,
and you just
I
get
assume.
Nothing.
You get zero.
Okay.
You get zero. That's a possibility with a stock, right? A company could literally go out of business. Now it's rare, especially for the large names that we know, but it is a rare occurrence. So speaking of housing. If you look over the last month or two, housing is actually sales are down. Housing is starting to level off, fall off a little, which is natural. You come through a big swing up. Eventually, trees don't grow to the sky, so there's going to be a correction or a deviation back to the mean, and that's what's occurring in housing. The supply of new homes is up for the first time in a while, so real estate people were excited because there was low inventory and buyers were going crazy trying to buy homes all the time, bidding them up, sometimes paying cash, sometimes paying more than was being even asked, right?
Oh, yeah. I went buying my house. That was the 8th place we put an offer on before we finally were able to get one, and people were just like paying cash out of nowhere and like way overvalued.
Yep. Yeah, which was not uncommon and certainly not uncommon in Central Florida. But what we're seeing is inventories coming up. What we're also seeing is the median price of a new home sold in February was up 10.7%, and the average price of a new home sold was $511,000. Think about that. That's insane, and that is up 25% over last year. So a lot of people own homes. A lot of people are interested in the value of their homes. You hear people talk about it all the time. Just a little bit more than they would talk about stocks and bonds, but again, because the number of people with owning homes, the home ownership percentage is higher in this country than the ownership of stocks. But as you've said many times about Robinhood and alike trading platforms, that's changing, but that's a completely different animal in the stocks that people are buying on. 85% of the trades on Robinhood sells are done at a loss. That is the statistics on that.
Oh,
so,
good. So I'm in with the majority.
So you're in good company there, my friend. But it's not uncommon.
Well, that's one of the weirder parts about that, and like having like a Robinhood and like people like me getting into stocks is people post online, and there's this thing just straight up known as loss porn, which is essentially people post how much they're losing as like a joke. Like, look, I lost my grandma's whole investment, and they'll post it online, and people will laugh because another guy will definitely be in the comments and go, oh, well, I didn't lose that much. I only lost 20,000, not 80,000. It is a weird trend on the internet, which is just insane, but I get it.
Yeah, it is fascinating, but and the problem with that, as I see it, is not so much these losses, because the average account size on Robinhood's like a few $1,000s.
Yes.
It's not people with millions of dollars, which is good and bad. It's bad because most of them are young people. And the problem I have with it is not so much the experience. I think the good news is people are getting into equities and securities and thinking about it. The bad news is they're doing these really silly things in terms of what they're buying. And my fear is they're going to do it. They're going to get their behinds whooped. They're going to lose money, and they're never coming back in a practical way. In other words, they're going to say, well, this whole thing's rigged. It's all a scam. And then then the idea of buying Procter & Gamble and Exxon and acquiring good quality long-term dividend-paying stocks is now out of the question to them because of that experience they had, which was really a completely different animal. There's speculation, which is what they're doing, and there's investing. Those are two different things. So it's frustrating to me as an advisor of 35 years that thinks everybody should set aside some money to invest, even whether it's a home or real estate or stocks and bonds, because I think what people are being taught by this gamification, if you will, of investing, it's going to turn them off, and they're never going to come back. And I see it all the time. I see people who have made mistakes early in their life and have painted the whole thing with a big broad brush as being a scam or unfair or only for the wealthy or whatever, and it makes them bitter, and it makes them refuse to participate.
I feel 100% that way, because I felt that way about credit when somebody just literally put a credit card in my hand. Day one, I turned 18 at the Altamont Mall. They're like, sign up. It was just a kiosk. And then after just destroying my credit, I just never used it again for like a decade. And I just learned to pay everything with cash. If I can't afford it, just buy it, until somebody talked to me about how they did their credit and like, not loopholes, but the ins and outs of it. And it just like a light bulb went off. Like, oh, I could have been doing this the whole time.
Yeah, there's a legitimate way to do anything, right? And credit's a great example. I talked about it before. I got my first credit card at 18, and I went out and bought beer with it, and that was the end of it. I got a $500 limit, and 3 weeks later, I bought a lot of beers and made a lot of friends, and then it took me like 6 years to pay that $500 back. So that was a very expensive quarter beers that I bought those few days.
Probably at like 29% interest.
Yeah, it was insane. So that's bad, but leverage to buy a real asset, like taking out a mortgage for a home, that's backed by a real appreciating asset. So using the bank's money, if you will, to buy that asset that's appreciating at the same time. And by the way, you got to live somewhere, so you might as well do that rather than pay somebody else's mortgage for them, which is what you're doing with rent. I mean, So like anything, it's what you do with it. You know, if you use a hammer to drive a nail, that's great. If you beat your brother over the head with it, it's not so great. So not that I've ever done that, by the way, but
That's a very specific.
that was.
example.
I'm sorry. Yeah, that's memories are coming back, flashbacks. He had it coming, by the way. So yeah, so like anything, investing when done correctly and over the long term with a process and a discipline works. When you're just buying meme stocks because you like the way that looked on Instagram, that's speculation. That's pretty much a game. You're gamifying what is a legitimate and real process.
Well, if you're tired of banging your head against a wall, you should go to edgewaterfamilywealth.com. That's right. Scott will help you out. It's super easy to get to. It's edgewaterfamilywealth.com or 407-648-1881. We'll be right back with more It's Only Money.